We are a publicly net lease REIT with a niche investment strategy and a strong, experienced management team that has a long history in retail property types. We typically acquire assets with high visibility frontage that are fungible and suitable for multiple tenants and have excellent access with high traffic counts. These assets are generally leased to household name, national, and strong regional service tenants with solid credit that are under long-term leases. Our assets, being fungible, attract a variety of different users and are in strong demand from tenants and operators. Switching gears to the marketplace. We compete in a marketplace where buyers are typically less sophisticated, so we rarely compete against public REITs or institutions, which allow us to have a competitive advantage and to achieve competitive acquisition pricing. Our management team has decades of experience in the real estate field, carrying deep-rooted tenant and industry relationships that help us make better decisions for our shareholders. Lastly, with respect to our balance sheet and our balance sheet strategy, we are leverage conscious, trying to maintain ample liquidity, being good stewards of capital as we scale our business. I believe at the end of Q2 25, our debt to EBITDA was just about 5.5 times and sub 40% LTV using consensus net. Yeah, sure. Good question. We formed our REIT in 2016 and went IPO last October. The idea was to access both debt and equity capital to scale the business. I personally have over 20 years working as an open air shopping center developer and owner, where I found this opportunity to invest in these assets with frontage because of inefficiencies that I found in their respective marketplace. The REIT structure offers several benefits, including surety of close and really the best access to capital. It also allows us to borrow at lower rates than private and access deeper pools of capital if we need it. The acquisition marketplace is pretty favorable right now, and having access to capital allows us to acquire these frontage assets at what we think are historically elevated cap rates. Additionally, we are actively recycling assets, and we have found that the deals we are currently putting into the marketplace are sought after by several buyers at cap rates generally in the 50 to 75 basis point range lower than our acquisition cap rates, a pretty nice spread. For cadence purposes, we acquired just over $67 million of property in the first half of 2025, and we recently guided to about $120 million of acquisitions for the annual 2025. Our platform is highly scalable with the right team in place to increase the pace of acquisitions if it is accretive for our shareholders. We have long-standing relationships in the marketplace that allow us to see many acquisition opportunities with opportunistic pricing, as well as accretive asset recycling opportunities that improve our portfolio composition. Finally, we have the team in place to grow our business and increase acquisition activity with the appropriate cost of capital. These are great assets. They're operated by strong household name service tenants that are typically hiring and expanding today. We see growing demand for these fungible assets with frontage as new users, for example, enter the marketplace, existing users expand, and larger format tenants can downsize and move to frontage locations, giving them exposure to these very busy streets. We call these assets brand building because the tenants get to design their own building, their own signage, and their own prototype, and then they market, or so to speak, advertise this to the tens of thousands of cars that pass by their frontage locations each day. New construction for frontage boxes is very expensive, and we see that our existing assets can be meaningfully below replacement cost. Generally, net lease REITs trade at a, call it say 15 to 25% premium to NAV. And recently Green Street published that this sector is at a premium, which allows companies to issue debt and equity accretively to buy new assets. So listen, real estate and net lease are certainly interest rate impacted. And there is usually a delay between cap rate expansion and higher rates. I would say that if rates remain stubbornly high, spreads could continue to narrow with modest organic growth. Some of our peers have interest rate headwinds from debt issued 5 to 7 years ago when rates were nearly zero. Fortunately, our debt was issued in 2024 and therefore is not a meaningful issue for future growth for us. Credit concerns are always a topic in net lease, but I would highlight that us, and I'd say our peers, have very modest credit loss due to high diversification, along with strong underwriting of credits. Listen, in a risk-on environment, when people want to buy growth, AI stocks, net lease is really a much more boring, stable income stream. But our company does have the ability to grow fast, given our size, along with a very stable dividend, low payout ratio, strong balance sheet, and diversified tenant base. We will continue to always make the right decisions for the shareholders and the company. We have a strong team in place that can execute with real estate and capital markets experience. We have a diverse, desirable, liquid portfolio with frontage that is fungible. We are careful, prudent capital allocators, managing leverage with a strong balance sheet. Our business is scalable with no major G&A required to grow. We have a strong pipeline of acquisitions waiting, and we have demonstrated asset sales are accretive with our liquid and fungible portfolio. Lastly, we have a low stock price and an elevated dividend with a 66% payout ratio at the end of Q2 25.